So I want to use the opportunity of Mark's talk to kind of revisit some thinking about private equity. It also ties into a conversation that Ford Manel had a gathering of teams. It's been since 2019 when I last stood on the stage and talked about private equity, so just a little refresh on this. Well, in 2019, they raised $565 billion to pursue acquisitions. I said at the time, I think this is going to continue for some time. Clearly it did. 5 years of raising close to 500 or more than $500 billion. Ernst & Young estimates that $1.6 trillion of dry powder. Match that with debt, they're looking at about $3.2 to $4 trillion of purchasing power. So it's not a surprise when we surveyed you guys last fall in the biannual member survey, 85% of you said that private equity is active in your industries. That's incredible. It shows you they have so much capital, they're going into all sectors of industry to try to pursue deployment of that capital, as well as going international. Interestingly enough, in a low interest rate environment, this probably made sense. In a high interest rate environment, which we are now, and we'll probably head into a higher one going forward, it makes a lot less sense. This was Dan Rasmussen in his newsletter just a week ago or so, and he basically cited this gentleman, Ennis. Dan himself is a very severe critic of private equity and wrote a very good book about this. But he said in an era of near zero interest rates, private equity returns are looking more like public returns, just slower, less liquid, and far more expensive. If you remember my talk from 2019, I talked about Warren Buffett, and Warren's been saying this for at least a decade, if not two, that if you take the unlevered returns on common stock, keep in mind public companies don't put much leverage on themselves, and you compare it to the unleveraged returns on alternative PE, keep in mind they put a lot of leverage on their companies, but remove the leverage being risk, common wins. So his point would be, you would be much better off if you want to take that level of risk, borrowing the money yourself and investing it in an ETF like VU, a low-cost S&P 500 of American companies. That's what he would recommend. Well, interesting enough, private equity is seeing some slowing. We don't know exactly, but we know they're raising less money this year than they did in the prior years. And I think what's happening is the pension funds, which are reasonably sophisticated investors, they're not very sophisticated to be honest, but reasonably sophisticated. The problem is you have somebody running a large pension on behalf of a the firemen or the policemen, and they pay them $150,000 a year to write $300 million checks. There's a mismatch there between who they're giving the capital to and the experiences they have. But we'll call them reasonably sophisticated. So what does private equity want to do? They want to put this in the hands of retail investors. They want retail investors to buy into their funds. I think they're doing this in response to the slowing they're feeling. And the SEC is feeling pressure to do this. Private equity has very significant lobbying power. But Moody's, 4 days later, said, oh, this is a really bad idea. And I'm very happy Moody's is doing this. I think this is a horrible idea. We'll see how this all plays out. But if they do not get access to the retail investors and the moderately sophisticated LPs start pulling back, there may be some slowdown of the capital they're able to raise. But they're not going away. So how do we feel about it? Has our point of view changed? Not at all. In fact, I'm starting to think about this as almost like kryptonite for Evergreen companies. You guys have these incredible superpowers. Dick Tracy talked about that this morning. Mark referred to this. And this goes right at the heart of it. Think about Kent, what he said. It goes right after your purpose. Because as soon as you take that first dollar of private equity, as I said to Mark, your purpose now is to maximize returns for your investors. Nothing else matters. You can put anything on your website, your business cards, anywhere you want. None of it matters because in that boardroom, that point going forward, you will be working to maximize their exit value. And that will be done in direct and indirect legal terms and moral terms of that relationship. So Donna and Mark, I think they did what you're supposed to do. The safest approach is just say no, and he did. And I really respect what he did. These were not comfortable conversations with Mark. Mark is a very forceful personality. He's a very clear thinker, but we had some good conversations. Jack was right there too, Jack Stack in the conversations. And I meant this, at the corporate level, if you take a dollar of private equity, you really cannot be an Evergreen company anymore. And he took that seriously, and he did the hard work, and I think it's led to a really wonderful outcome, and his vision will now come to life, which I think is a beautiful one, of having employee ownership and not being denied what he was denied, which he was given nothing for building that very successful company earlier in his career. He's going to make sure every employee has a chance to participate in the success of Craftsman, which is a beautiful thing. So I want to use this as an opportunity to talk a little bit about our learning philosophy, and you'll see why in just a moment. But our aim, my team's aim, is to expose you guys to the wisdom, best practice, and fresh ideas of this group, of your peers, both in person and streaming, and unfortunately those who can't join us at all, because there's a lot of incredible ideas and wisdom in this group. We also want to expose you to the ideas of other Evergreen companies, may not be members today. We've done that through things like the Enterprise Rent-A-Car Visit. And we want to have aligned thought leaders speaking also. We have many of those today and tomorrow. And we want to cover the topics of business, Evergreen families, and how to take good care of yourselves, because as the leaders, it's really important you do that. We also want to selectively surface practices from other models, VC, private equity, public companies, that we believe will serve Evergreen leaders. And we're trying really hard not to be dogmatic. It's so easy to be dogmatic about this. They're bad guys, ignore them, but we're trying to see what are the essence of things they do that we can bring in to share with you guys that might be of value to you. And lastly, and very importantly, and I hope you understand this philosophy, it's your call. These are your businesses, these are your decisions. If you want to explore something, it's great. You want to adopt it, that's great. If you want to leave it behind, that's fine too. We just want to make sure you see as many ideas as possible so you don't have any blind spots. So this kind of leads to Ford. So Ford gave a presentation at Gathering of Teams, and he talked about, as part of the conversation, it was a great presentation, I'll say that. It got very high marks, but I asked him to talk about a kind of what I call unexpected approach to outside capital. It surprised me, to be honest with you, and you'll see why given what I just said a moment ago. It was based on some guidance that he had gotten from his grandfather, and it was basically the idea was the time to take a tart is when the tarts are being passed. Interesting enough, Eugene Kleiner at Kleiner Perkins taught this to all the partners, and was taught to me. There's financial risk in all companies, and if capital is available and being put in front of you, you might want to take some of that. In fact, what Eugene used to say was when the tarts are being passed, you might consider taking two, not just one. So how does that come to life in Ford's strategy? Well, what happens in the milling business is these mills are very capital intensive, and they come for sale very rarely. Ford will say as often as once every 100 years. So you need to be in a position, if you're Ford and is ambitious to build his company, to be able to acquire them when they come available, and he can't plan in advance. So he generally felt, given the balance sheet he had, he could acquire one a year. It'd be about the maximum he could do, but he wanted to have the capacity to do two, just in case the situation arose. And it has arisen twice, and he's been able to take advantage of it. And what he's done is he's levered with private equity, but not, and I'll explain this in just a moment, in the way that I consider to be as dangerous as the ones we just talked about. So private equity, private equity, debt, and bank debt. And he explained this at Gathering of Teams. $8 million of his equity unlocked $35 million of total capital to these leveraged structures. And he was very selective about who he chose to work with. He wanted to make sure that, one, their financial expectations were aligned with what he could deliver. He was very clear about what that would be. And two, he wanted to make sure it was a strong cultural fit, that he did care about their values and their character. So the better people in the spectrum of PE partners out there. And then he did something smart. He said, you guys are the experts in negotiating debt. That's what you do all the time. You negotiate on our behalf. I will get better terms by you doing it than me doing it myself. So again, this was kind of an unexpected approach that I thought was pretty interesting. This is the key thing, and this is the part that was so subtle I think might have gotten missed in his presentation. He's not doing this at the parent company level. This is being done in a separate legal entity. He owns 75% of it. This is the example he gave. Private equity owns 25%. His goal is to integrate in 3 to 5, maybe 7 years. Integration means paying off the equity, getting rid of the debt, cleaning it up before he brings it into the parent company. So it's isolated and boxed out, and he's done a lot to protect that. And in fact, he's set up a agreed upon divorce plan that he controls. So he's the only person who can buy it, PE can't buy it, and if it's not working, he can shut it down. He can move it outside the company and sell it. So I thought that was kind of a clever approach, one where it kind of made me think, maybe there is a way to kind of think about private equity and leveraging all those tarts being passed around, or at least the ones being passed around recently. It did also remind me there was a really interesting approach, too, we haven't talked about in a long time. And this is what SRC Holdings does. And I think Jack talked about this yesterday in the ESOP gathering. It's this idea of doing strategic joint ventures, another way to unlock capital. And he's done this successfully with his team 12 times. And this is extremely capital efficient because they don't put up any capital. So they do a 50-50 joint venture. SRC provides the team and the know-how, and then the strategic partner provides the capital and some market knowledge and a predefined exit path for that joint venture. Similarly, Jack worked very hard to mitigate risk around this and really isolate the risk associated, because corporate partners can be as nasty as private equity guys. And we've seen this before. In fact, sometimes in acquisitions, they can even be tougher. Surprising, but they can. So an independent legal entity. And in this case, the goal and the objective, which I missed saying earlier, is to actually generate cash to help fund the ESOP obligations. Because a very successful ESOP, you have strong obligations related to retirements, plus fund other investments that they wanted to make. So what Jack had was a predetermined put option and price. This is all set up up front. So as long as they achieve the financial milestones and time-based milestones, he just can call them up and say, look, it's time to buy the company, and then he brings the cash into SRC. Now, SRC can buy the joint venture also. He said that's not the intention of it, but he has the flexibility to do that also. And a little bit surprisingly, and Jack wanted to highlight this for me last week, he said, but the thing here, not only does it kind of achieve the dual objectives of they're getting a joint venture that they can acquire into their business that we built, and we've got the cash available for our business, this is actually creating incredible opportunities for the SRC team. Because some of our top people can go in and really become entrepreneurs in building these joint ventures and really showing levels of leadership maybe earlier in their careers than they've had otherwise. He said, and is leading to great jobs in the Springfield community because these are being built by my team under our values and the way we think about people. So it's really good for his local community. So another kind of creative idea to kind of make sure we're not being dogmatic and open-minded about things. So just to recap, no change in opinion on private equity at all. And unfortunately, they're not going away anytime soon. In fact, I think their behaviors are going to get worse, not better, because they have to refinance all this debt. And they're doing it at higher interest rates. That means it's going to be draining more cash than their original models for the acquisitions. So they're going to have to squeeze the turnip even harder to generate cash, which I think is ultimately, it's going to be the people. They're going to just push even harder on the people, unfortunately. We do want to expose you to very interesting ideas we think would benefit you. I do admit I probably made a mistake having that presentation by Ford at Gathering of Teams, and I got that feedback. That would have been better here, because when you say the word private equity and you have executives sitting there listening to this, and it's in 20-minute presentation and it's tight, it can be misinterpreted. And so that was not the intention by Ford or myself, but I do think with Ryan and Jackie, be more thoughtful about where we share particularly radical ideas. And remember, it's always your call. What you want to explore, what you want to adopt, what you want to leave behind. But we do want to put these ideas in front of you because we want to make sure that we minimize any blind spots and have you see any opportunity we think is out there for your evergreen businesses. So I hope that makes sense. I welcome any feedback you may have on this, and thank you. Appreciate it.